Something they don't teach you in schools, not because it's complicated, but because once you understand it, you start asking questions they'd rather you didn't ask. Think about the last time you felt financially secure, really secure. Not just okay, but genuinely confident that what you'd saved, what you'd built, what you'd worked for was actually safe. Hold that feeling. Now ask yourself, honestly, how much of that security was real? And how much of it was just the absence of information? Because there's a pattern, quiet, predictable, almost mechanical sequence of events that is played out across dozens of economies over the past century. Different countries, different currencies, different generations, but the same 7 steps every single time. And the most unsettling part, the people living through it, in the middle of it, deep inside it, almost never recognized it until it was too late to matter. Let's start with something simple, something you've probably never questioned. Money feels permanent. It feels like a foundation. We build our lives on top of it. We measure our safety with it. We count it, save it, protect it. But money isn't a foundation. It never was. It's an agreement, a collective act of belief. And like all beliefs, it can quietly shift without anyone sending you a warning. The first stage is always the most invisible. It doesn't arrive with headlines. There's no announcement. In fact, the first stage often looks like prosperity, growth, confidence. A decade, sometimes 2, where everything seems to be working. Debt goes up, but so does output. Asset prices climb. People buy homes, start businesses, take risks they wouldn't have taken a generation before. And somewhere in a quiet background, the foundations are being subtly hollowed out. This is what economists call the expansion phase. But that word, expansion, it flatters what's actually happening. Because not everything that grows is healthy. A tumor expands, a bubble expands. Growth without structural integrity is just accumulation before collapse. In this first stage, the warning signs are there. They always are, but they're easy to dismiss because everything on the surface looks fine. Employment is up, spending is up. The evening news reports record highs in the markets, and nobody thinks to ask what exactly is being measured and who exactly is benefiting. The second stage arrives like a slow tide. It doesn't crash in, it seeps. This is when the debt that felt manageable starts to become structural. When the promises made during the good years to pension holders, to bondholders, to future generations, quietly outgrow the economy's ability to keep them. Governments don't advertise this. They manage it. They roll it forward. They refinance it. They reframe it. And for a while, the math almost works. But there's a moment, and nobody announces this moment, when the gap between what is owed and what can be paid becomes unbridgeable without consequences. That's the moment a system crosses from stress into fragility. Here is the part that gets overlooked every time. Fragility doesn't look fragile, not at first. A bridge can be structurally compromised for years before it fails. The rust is behind the paint. The cracks are in places no one regularly inspects, and the people crossing that bridge every day have no reason to worry, because it hasn't fallen yet. And in the absence of collapse, most people assume safety. This is the third stage. The stage where trust, not money, not policy, but raw human trust in the system is being silently borrowed against. Think about trust like a bank account. Every functional economy runs on it. People trust that the dollar in their pocket will be worth roughly the same tomorrow as it is today. They trust that their employer's pension will be there when they retire. They trust that the bank won't quietly change the rules. They trust that what the government reports as inflation reflects what they actually feel in their lives. A peace. That trust is the real reserve currency of any civilization. And in stage 3, institutions began to spend it, not recklessly, not obviously, but consistently. A little misleading data here, a quiet policy change there, a technical adjustment to how inflation is calculated, a redefinition of what counts as employment. Each one individually seems minor, defensible even, but cumulatively, something is happening that doesn't show up on any official chart. The story people are being told about their economy slowly diverges from the story their own lives are telling them. And people feel it. They just don't have the language for it yet. You know that moment when you're in a room and something is slightly off, but you can't name it. The temperature is normal. The lights are on. Everyone is talking, but something doesn't feel right. That low-grade unease. That's what stage 3 feels like from the inside. By the 4th stage, The machinery of management becomes visible, not to everyone, but to enough people that the official explanations start to require more effort. Central banks began extraordinary measures, quantitative easing, near zero interest rates, liquidity injections, asset purchase programs. The vocabulary becomes technical on purpose because technical language is harder to be angry about. And on one level, these interventions work. The system doesn't crash. The panic doesn't materialize. The crisis is averted, or rather, it's deferred, moved forward, made someone else's problem in a future that hasn't happened yet. But here's what those interventions do to real people in the present moment. They inflate assets, okay? And assets, by definition, are owned more by those who already have them. So wealth concentrates, not violently, not dramatically, just quietly, systematically, arithmetically. The person with 3 properties benefits from low interest rates. The person saving for their first home gets priced further away with every year that passes. The corporation with access to cheap capital expands. The small business owner paying retail rates gets squeezed. Nobody planned this as an outcome, but it happened. And it keeps happening. Okay, the distance between those rising asset values and the flat wages of ordinary working life, that gap becomes the silent architecture of resentment. The 5th stage is where things get genuinely uncomfortable, because the 5th stage is where the distortions become undeniable, where even the optimists start hedging, okay, where the word that nobody wanted to say starts appearing in mainstream conversation. Inflation, not the cleaned out, seasonally adjusted, core CPI version, the real kind, the kind you felt at the checkout, the kind where you're buying the same things you always bought and somehow spending more, and the raise you got last year already feels like it happened 2 recessions ago. This is the stage where the gap between the official narrative and lived experience becomes impossible to paper over, where the person working 2 jobs starts doing math that doesn't add up no matter how they run the numbers, where their retirement savings that looked reasonable 5 years ago suddenly look like they won't and last as long as they were supposed to. And the thing about stage 5, the truly disorienting thing, is that it still does by collapse. The lights are still on. The stores are still open. The market is volatile, but not dead. People are stressed, but they're adapted, adjusted, cutting back here, dipping into savings there. But underneath the adaptation, something psychological is shifted. The assumption that tomorrow will be better than today. That unspoken faith in forward progress that modern economies run on. That assumption is being quietly revised, not abandoned, just questioned, okay? And when enough people quietly question it at the same time, the system begins to behave differently. This is the point where assets that seem unconventional start looking lasher, not because people are panicking, but because they're doing math. Cold, clear math. And the math is suggesting that holding value in conventional places may not be as safe as they were told. Gold moves. People who never thought about precious metals start reading about them. Bitcoin flows. People who dismissed it years ago start asking questions. So, the overlooked industrial historical monetary net starts attracting a different kind of attention from speculators, from people who are simply trying to preserve what they've worked for. And here is where something very specific happens that almost nobody talks about openly. The metals markets, particularly silver, operate under rules that most retail investors don't fully understand. The price you see on your screen is simply the result of supply and demand in the conventional sense. It's a price discovered through a system of paper contracts, futures markets, and institutional positions that can be, and have historically been, used to manage the narrative of what these assets are worth. Think about that for a moment. If people fleeing a weakening dollar rush into silver and silver's price surges dramatically, that surge tells a story about confidence lost, a story about institutional failure. So a dramatically rising silver price isn't just a financial event, it's a public signal, and signals can be managed. Not through conspiracy, through mechanics, or the sheer weight of paper positions in futures markets that can suppress price discovery in ways that are legal. It's documented, have been subject to regulatory scrutiny for decades without fundamental resolution. The result is a commodity that, on paper, trades at prices that don't always reflect genuine physical demand, an asset that should, by historical logic, be priced significantly higher, given its industrial scarcity, its monetary history, and the volume of above-ground stocks relative to gold, and yet consistently trades at a range that keeps it from telling the story it would otherwise tell. There's a reason institutional players take large short positions in silver. There is a reason the ratio between gold and silver prices has been structurally elevated far beyond its historical norm for years, and that reason isn't mysterious. It's strategic. If the price of silver were allowed to find its genuine market level in an environment where dollar competence is weakened, it would become one of the most visible, accessible, and undeniable indicators of systemic stress. And accessible is the key word, because unlike gold, which requires significant capital to accumulate meaningfully, silver is within reach of ordinary people. It's the cheapest metal, historically, which is precisely why its price behavior is managed most carefully when ordinary people most use highest signals. Now, Bitcoin arrived with a promise, a decentralized, uncensored, mathematically fixed store value that couldn't be printed, plated, or manipulated by any government or central bank. And in concept, that promise is real. The underlying technology is genuinely revolutionary. The scarcity is genuinely programmatic. But here, that's what the early narrative did fully account for. The infrastructure built around Bitcoin is not decentralized. Exchanges, the custodians, the futures markets, the ETF wrappers, the entire ecosystem through which most people actually hold and trade Bitcoin is deeply structurally centralized. And centralized infrastructure can be stressed, regulated, seized, or simply failed. The crashes that have periodically devastated Bitcoin holders, the ones that seem to come from nowhere and take everything, most of them didn't originate on the technology. They originated in the infrastructure, in leveraged positions, in exchange insolvencies, in regulatory actions, in the behavior of large institutional holders who entered the space not to liberate it, but to profit from it. The retail investors, the ones who truly believed in the promise and invested their hard-earned savings, were left holding the bag. They absorbed the losses, while the big institutions simply repositioned themselves for the next cycle. Now, this isn't about criticizing the technology itself. It's a critique of how new technologies often get co-opted by the very systems they were meant to disrupt. It's a sobering reminder that the tool for liberation and the tool for harm can look exactly the same, right up until the moment they split apart. This brings us to the sixth stage of the pattern, where official reassurances start to sound like background noise. Every press conference, every policy announcement, every revised GDP figure is wrapped in language that sounds confident, but if you look closely, it's all conditional. It all depends on outcomes that haven't actually happened yet, This is the point where the language of management becomes the language of hope. And let's be clear, hope is not a policy. Hope is what institutions turn to when the policies have run out of road. Then comes the seventh stage. We won't dwell on this, because the goal of understanding this pattern isn't to fall into despair. The seventh stage is the resolution, tear. It's the painful, it's often chaotic process where the imbalances from the previous 6 stages are forced to reconcile with reality. Sometimes it's through hyperinflation. Sometimes it's deflation. Sometimes it's through war, which, if you look at the economics honestly, is often just a catastrophic way to resolve debt. Other times, it's a negotiated restructuring or decades of slow, grinding decline, where living standards gradually fall, and each new generation just accepts it as normal because it happened too slowly to remember anything better. But every version of this final stage has one thing in common: the people who understood what was happening, who didn't wait for official confirmation, who trusted the pattern over the narrative. ended up in a vastly different position than those who believed the system would fix itself right up to the very end. They weren't cynical or doomsayers. They were simply paying attention. So here's a question to sit with for a moment. If you're living inside the fifth or sixth stage of this pattern right now as a future theory, but right now, what signals around you would confirm or contradict that idea? Think about the purchasing power you feel or don't feel from your income. Think about the cost of housing compared to what your parents paid and earned. Look at the official inflation numbers versus what your grocery bill actually says. Consider the interest rate environment and what it did to every so-called safe asset you were told to rely on. Look at the behavior of precious metals, the wild ciphers of crypto, and the rhetoric coming from the institutions. Look at all these things together without the filter of what you want to be true. The answer you find quietly, privately, based on evidence. Not fears, the start of the financial literacy that no institution will ever teach you, because real literacy leads to questions. And at a certain point, those questions become very inconvenient for the people in charge. The people who understood the debasement of currency in ancient Rome before the empire fell didn't panic. They converted their assets. They preserved their value. They thought on longer timelines than the system wanted them to. The people who understood the situation in Weimar Germany before the collapse didn't give speeches. They held real things with intrinsic value, things with thousands of years of monetary history, things a printing press couldn't create out of thin air. The people who saw the 2008 financial crisis coming didn't trust the AAA ratings. They actually read the documents. They followed the logic to its inevitable conclusion. They weren't smarter than everyone else. They were just willing to sit with an uncomfortable truth long enough to act on it. It's that willingness, that quiet, deliberate, unemotional willingness to see things clearly is the most valuable financial skill you can possibly have. It doesn't require wealth or a fancy degree. Only requires the courage to trust your own analysis over the comforting consensus of official reassurance. The pattern is real. The stages are real. The mathematics of unsustainable debt, debased currency, and eroding trust don't just suspend themselves because it's politically inconvenient. They operate on their own timetable, As the old saying goes, it happens slowly, then all at once. The people who understand that phrase aren't afraid of it. They're ready for it. If any part of this made you stop and think differently about how economic systems actually work, not how we retold they work, but how they truly behave over time, then the most valuable thing we can do now is to keep going. Keep asking questions. Keep reading things that challenge what you want to believe. The systems that impact your savings, your security, and your future are not beyond your understanding. They just require you